In today's video, I want to talk about one little dirty word, recession. Recession refers to a period of weak declining economic performance and is officially defined by 2 quarters of negative GDP growth. In the past month, there's been a lot of recession talk. And according to the Financial Times, a poll they took before the most recent Federal Reserve rate hike, 70% of top economists said they believe a recession will happen next year. And in a survey by the economist YouGov, more than half of Americans already think that the economy is in recession. Americans, and honestly, many people around the world are feeling the pinch of rising prices because a typical household now spends $460 each month more on the same basket of goods than they did last year. And for a lot of families, that's a huge amount. We can only imagine how those odds have changed since the Federal Reserve raised interest rates. The stock market is already in bear market territory, with the index falling at least 20%. GDP growth turned negative in New Zealand and the UK. It was quite a shock this past week to see New Zealand growth fall, minus 0.2% in the first quarter, and the UK economy to shrink in March, which means that the quarterly number has a very real risk of being negative as well. The cost of living is biting hard for consumers in the US and abroad. And now we are even hearing that job interviews are being paused, which is bad news for the labor market. What does all of this mean for investors? Well, let's just get this out of the way first, which is that no one, I stress this again, no one ever wants a recession. But recessions may not be so bad. While recessions do stand the risk of turning into a depression, and I don't think this one's likely, they can be long or short. We had a technical recession in 2020 that lasted only 2 months. And remember how grim we all felt when the pandemic hit. But we don't know how long a recession will be and how long it will last until it's actually over. And when you're living through one, it can be a very depressing experience. But knowing what could happen and being prepared gives us the edge to make good decisions. In the US, there's been 14 recessions since World War II. And 3 in the 21st century alone, in 01, 08, and 2020. Since 1945, the S&P rose an average of 1% during all recession periods. Of course, this number is misleading and distorted slightly because you have the big drops that occur when a recession begins and a recovery at the end. And stocks always recover before the economy. Here's a look at how stocks performed during the last 14 recessions. The one thing to know is that it always comes back. In almost every case, the S&P 500 bottomed about 4 months before a recession ended. The US dollar soared to multi-year and in some cases multi-decade highs over the past few months. As shown in this picture, the US dollar, typically rises in value during a recession. We saw that in the 1980s, 1990s, 2000, 2007, 2009 recession, and then, of course, the Great Recession. The reason for this is that first, the greenback benefits from safe haven demand and flows, and then later, the hunt for yield drives investors into the returns of dollar-based securities, assuming that the U.S. recovery will lead the global recovery. During a recession, gold also tends to perform very well, as you can see in this chart here. This is a graphic I got from Capital.com showing cross-asset performance during recessions, and you can see that gold performs well, oil performs poorly, dollar performs well, dollar yen and the British pound tend to weaken. The good news, and there almost always is one, is that post-recession, stocks have always come back. And when stocks come back, so do currencies. 3 years after a recession, stocks have on average risen 46% since 1945 and 120% 5 years from a recession. So while current times may be depressing, if you have disposable income and can look past the fear, scaling into the index as it falls should be the right trade. Recession risk in a rising interest rate environment is actually great for us Forex traders. It means big moves and strong continuation, like this beautiful CAD-yen zip trade signal that we had last week that also had 2 sell signals the day before. In this Aussie CAD chart, you can see that there were some nice zip sell signals along with a consistent downtrend. This Kiwi dollar chart showed that we had a very consistent downtrend that confirmed we should be selling and not buying throughout the past week. Check out bkforex.com if you're interested in learning how to trade my ZIP strategy, and have a great week.